what are the main risks that the tech sector face? In other words, what would need to happen for valuations to compress and stock prices to come down for these Mag 7 stocks? What challenges and opportunities lie in the tech space? Which subsectors within tech are seeing the most growth right now? Joining us to discuss this is Jordan Knopf, co-founder and managing partner at Tusk Venture Partners, a venture capital firm dedicated to technology. Welcome to the show, Jordan. Good to see you.
Hey, thanks for having me, David.
Let's talk about your fund. So, venture capital fund, what do you focus on primarily?
Yeah, so we're an early stage venture capital firm focused exclusively on investing into companies that are operating in highly regulated markets based in New York. And so the areas that we typically look to invest in typically fall into areas, obviously, that are going up into highly regulated and burdened markets, but also, we're chasing sectors that, under the theme that regulation always lags innovation, and that, emerging new sectors that, are going to be going up against these regulatory headwinds. That's exactly where we want to invest.
So tell us about some of the types of companies you look for right now.
Yeah, sure. So look, we're really interested in obviously in healthcare, which is where we've invested in the past. That spans across behavioral health in general. But really that theme is focused around the fact that clinical judgment remains the scarcest asset in healthcare, and it will remain exclusively driven by humans. So while chasing AI's implementation into the healthcare system, we think that'll lead to some really interesting dynamics around custom patient charting and communication, and increased ability for doctors to spend more time with patients. And so evolving business models there are areas that we're really focused on. Another area is obviously the broader dynamics in fintech. So what we've seen is just a tremendous shift, to banking, away from banking as a service, that we think will continue to take play, and some really interesting aspects around in the payment side. I'd say that another area that we're definitely focused on is supply chain, specifically the dynamic with potential impacts from reshoring. That is a trend that we're continuing to see. So there's quite a few areas that we're excited about. Some of them all the way down to security and public safety. This is around deep fakes and prevention, but also just cybersecurity in general and information security overall.
I spoke to your business partner, Bradley Tusk, a while ago. We talked about how the Fed pivot could affect private and public markets, in particular with tech. How do you think rate cuts going into not just the last rate cut we have, 50 basis points, but rate cuts going into 2025, how are they going to impact liquidity for both private and public markets?
Great question. And I'm hopeful that, the decrease in rates it does benefit, equities overall, whether that's public or private. You start to see a little bit more of a turn on of risk taking behavior. So professional investors looking to take on more risk to meet their targeted returns. So we're optimistic that this will bring some liquidity to the private markets, which look a little bit different than in the public market side. I can walk you through both, but on the private side, we're eager that rate cuts hopefully will spur some increased M&A transactions. Partially that is the posturing of the FTC that people feel threw a wet blanket on that market. But that drives really important liquidity to venture funds like ours. They don't need to be big M&A transactions. This can be small tech. These can be sub $300 million exits. Those are the single and double hits that funds like ours do still rely on to drive liquidity back to our LP base. We think that overall the decrease in rates typically does bolster equity values in the public markets as well. So think that the same dynamic, except for the liquidity being less of the focus, much more around just accumulating equity value.
A couple of years ago, Y Combinator issued a letter to some of the projects they're working with, asking them to prepare for what could be a dry up of funding in the coming years. I guess that already happened. The letter indicated that they should prepare by stocking up cash, having a higher runway because funding could be difficult. Has it been difficult in the last couple of years?
Yeah, so this is tying everything back together, right? So we were just talking about rates coming down, and so venture funds, we're trying to send money back to LPs that commit to funds like ours, right? And so What we're seeing to continuing to transpire across the venture ecosystem is that it started at the late stage and it's gone all the way to early now, where there's a tremendous amount of competition for what has been a pullback from venture funds writing checks into early stage companies. It is not necessarily without a lack of appetite to do that. It's just the quality bar has gotten materially higher. So what we have seen is a crunch that started out with some trouble for raising later stage rounds of financing. That's somewhat that has gotten a little bit less the case and much more at the Series A now. An interesting dynamic is that compared to 5 years ago, 4 years ago, we're seeing a tremendously high number of seed stage businesses all competing for those Series A term sheets. So there's about 5 companies out there today for every one that will be funded at the Series A, which creates a really competitive dynamic. So it's not that deals aren't getting done. They are. It's just the bar for quality is just much, much higher now.
Before we continue with the video, let me tell you about a way that you can protect your data privacy, a very important topic. Data breaches are becoming more frequent, and it's getting harder to control who has access to your personal information. Just last month, a data broker breach exposed 2.2 terabytes of personal data from 1/3 of the US population. That is why Delete Me, today's sponsor, is more important than ever. It helps you remove your personal information, like your name, address, phone number, and more, from data broker websites that buy, sell, and trade your data. The process is simple. Simply submit your information, and within 7 days, you'll receive a report showing exactly where your data was found and removed. Delete Me continues to monitor and remove your data all year long. Get 20% off of all US plans today by heading over to the link in the description down below, or simply scan the QR code here on the screen to get started. Use my promo code DavidLin at checkout. Join thousands of people who trust Delete Me to protect their online privacy and take control of your data today. Yeah, the deal sizes are getting bigger, but there's fewer deals getting done, as what you've been telling me. I wonder what constitutes a good company now. Has the criteria changed versus a couple of years ago?
So it's a great question, and I think there's two parts here. So one is what venture investors are doing right now to manage a fund or a portfolio at this point in time. So conventional, if you were like, this is all in theory, less in practice, but in a choppy market like right now, you would want to make more higher concentrated, higher conviction investments, bigger rounds into your best ideas. Keep the portfolio rather small, but really capitalize those businesses well is a strategy that a lot of people do employ. And so that's part of the dynamic that you're seeing. The second part is that funds have gone on to raise really large subsequent funds, being the established managers. So as it's been a challenge for a lot of funds to raise capital, the largest ones, the platforms, if you will, have been able to do so very successfully. They've raised tremendous multi-billion-dollar vehicles, and investing into anything, writing a check that's less than $20 million doesn't really move the needle for them. So what we're seeing is, that Series A is happening at a much larger size, at about $20 million at this point. But the metrics that you see at that stage look a lot more like the Series B did 5 years ago. So while valuations have gone up and so have round sizes, what you need to prove to get to that point and to secure a Series A round of funding looks like north of $5 million in revenue right now, when it used to be $2 million. Those are just some high level heuristics there.
Is profitability usually criteria?
Definitely not at the early stage. So that's still Series A is still an early stage company. I'd say that this is a dynamic that has, it's been interesting to see over the last few years. So as you mentioned in the Y Combinator letter, calls to action by many funds and investors to early stage founders to, be very, very maniacally focused about their cash management and to get much more efficient with their businesses. And a lot of them did that. They did it, and unfortunately, a lot of that came at the sacrifice of growth. Now, some companies were able to manage both, and they just got much more creative with the way that they'd market and their spend to acquire new customers. That said, this market has been highly punitive to the companies that did cut back on their spend, became much more efficient, but unfortunately sacrificed some growth along the way. And so one of the most important things that people are looking for is a sound business model, what looks like product market fit, and then a really, really rapid rate of growth.
As a public markets investor, like myself and other people watching this, perhaps, I would be wondering whether or not the tech companies you're working with in the private market space are hugely disruptive to the existing large tech companies today. Meaning, are we going to see in the next couple of years some of these companies you're exposed to eat away market share from the Googles and the Netflixes of the world?
So look, it's a great question. I think that the way that big tech, let's call it, companies interact with early stage companies that are typically in a portfolio like ours is mixed, right? So obviously we're always trying to look for the most transformative one in a generation type businesses. That's our job. And hopefully we're trying to find the next Google or Facebook out there. But in reality, a lot of the exits that can be, from moderately successful to quite successful come via M&A by big tech. And so their unwillingness based on FTC posturing to transact right now has impacted negatively the venture ecosystem in a material way. Because if you think about it, those companies, they have outsourced R&D to acquiring smaller businesses. That is their strategy for growth. And so I think that competing with big tech is just a different form of it. They're not going head to head, but they end up, that's a path for exit for a lot of these early stage businesses.
Right, but is there tech that they're working on that you think will either completely change the existing tech landscape, or I guess eventually be absorbed by M&A?
So it's interesting. I think that there are obviously trends that are happening now that could compete directly with some of the big players out there. So for example, AI and the consumer behavior that we're seeing, even with just ChatGPT, just to give you a good example, just to stick with Google, you have, we've had a few interesting shifts here. So one is that a lot of consumers are now starting the search process instead of going into, whether that's Chrome or going to Google. That search doesn't start in the search bar. That's actually starting in ChatGPT. And so that would have a tremendous impact on the core business that Google has. You're also seeing some other dynamics that are maybe in a tailwind for a larger company like Google, like Amazon as well. So AWS. So these are cloud service providers, and the proliferation of AI and the amount of compute that they are commanding has been beneficial for those businesses. So I don't think it's I think there's a few ways to look at it. Some of the trends will benefit big tech, and some of them will be looking to compete away market share.
The We Robot event from Tesla, no doubt you've seen clips of that, if not the whole thing. The future of self-driving robo-taxis. China already has them, by the way. Waymo already has set up a footprint, and now Tesla is entering the space. What's the future looking like, you think?
This is a really exciting area, and it's not just on the robotic side. It's not just the personal assistant. It's not just the autonomous driving car. The applications here are so wide, and it's truly fascinating. Anything from if you're a researcher, having an assistant right next to you. If you're just trying to manage your day, having an assistant that can help you streamline your meetings and when to pick up your kids from school. But also down to some really advanced applications, as you're mentioning, around autonomous trucking, autonomous vehicles, like basically on the car side would completely transform the way that people get from point A to point B. I think it's a really exciting development. But look, I think that the costs would obviously need to come down across the board, not just on the trucking and vehicle side, but on just robotics in general. But we are seeing that trend happening, particularly with industrial and manufacturing applications.
Who's making these robots? Because presumably, if it's not every car company making robo taxis, and if we're going to assume that this is going to be a dominant trend going into the future, isn't that a case to short automobile stocks?
Look, I think that's a really good question. I'm
making a lot of big assumptions here, so we can challenge these assumptions. Yeah,
absolutely. Look, one thing that I would definitely consider there is the time horizon. Technology is, while this is really moving very fast, it is relative to the development in tech, right? A lot of on the venture capital side, companies are staying private longer. That's been a trend that's been happening. We could still be many years away from seeing widespread adoption of any of these concepts. And look, that comes down to your underlying investment strategy and how long you can stay short.
Would you use it just personally? Would you get in a Tesla robo taxi or a Waymo robo taxi or whatever the case may be versus driving yourself or just, a regular cab?
Absolutely. I mean, would I do that every single day, or do I want to try it out? I'd have to see what that experience is like.
Yeah.
Look, I think that I can.
What is the main benefit to consumers? Is it costs, lower costs?
So cost is one. Two, and I'd say a high amount of cost. Two is the productivity gains that you get while not needing to be behind the wheel. Imagine if you're able to spend, if it still takes you an hour to get to the office or even 20 minutes, having a highly productive amount of time there. Where you are in a quiet environment, so you're not necessarily moving from a train to a subway. Even if you're in a situation where you're not driving yourself, it is still full of disruptions. And you're above ground and you can actually get things done. You can take calls, you could be on your laptop. So you are extracting, additional, that commute time is no longer wasted. I think that's a huge benefit. Another major benefit is moving people around that are not capable of driving, whether that is a child or a senior citizen. You're talking about you're lifting a huge burden and a huge restriction on seniors, and you're also lifting a huge burden on parents that are at current steady state. A lot of time is being spent driving their kids around.
Okay. The other demonstration that was made at the event is the Optimus robot from Tesla, priced anywhere between $20,000 to $30,000. I think is the announcement. A lot of applications that could do chores for you. Is this just going to be a fad? You think, or do you think a lot of more companies are going to be entering this space?
It's really interesting. I think this is a theme that a lot of people talk about. At a price point, that price point now is very, very high, but I don't think we're going to see widespread adoption until that comes down. If that's the initial entry price point, do you think there is a lot of downward pressure here? I do think that we could see a tremendous amount of adoption over time. I think this, in terms of, the streets of New York or, any urban area, probably be a little bit harder than in the suburbs. I think that the use cases will continue to emerge for this. But I do think that this will be something 10 years down the road that we'll see much more prevalent. I do think that the time horizon for adoption will take some time. So,
of the companies that have pitched themselves to you over the last year, roughly, what is the percentage that is solely focused on AI or mostly focused on AI?
Look, at this point, the vast majority of companies have an AI strategy to some degree. I like to bucket companies into two areas of classification that have an AI focus. One is, are you selling it? Is it an AI first product? Are they selling a foundational model or an AI AI product to the end user? That's a pure AI company. That's an area that we're not typically investing in today, just because of the capital intensity and the technical lift and still the economics that we don't understand just yet. Where value is going to be created. The application side, we see a tremendous volume here. I'd say almost every company has some form of AI implemented into their either current product or long-term strategy. Now, sometimes it's far more, it's not a core part of the product. It can just be the way that they interact with customers in terms of customer support. It can just be, a better interface in terms of using native language application. Just to create a better UI and a better user experience. And then some of them are they're relying heavily on artificial intelligence in terms of either providing a deterministic or probabilistic model to drive decisions at the core product level.
Okay, so let's move back to the public markets. NVIDIA is currently trading at roughly 64 trailing PE. The NASDAQ average, I think, is like 42, depending on the day you're looking at. It is higher than a lot of its peers. It is higher than the NASDAQ average. People are talking about these Mag 7 stocks being overvalued just based on some of the multiples you've seen in the private market space. Would you consider these large tech companies trading at valuations that are rich?
Yeah, I don't think there's many people that are going to say that these are not highly valued businesses. I do think that we are in kind of a tale of of two cities here with regards to the private and the public markets. The public markets have been performing really strongly. They continue to, and I think that there's some cases that there's a lot of room to run here. People can make those just given the macro dynamics at play here, and as you mentioned earlier, the decreasing rates. That should favor these stocks as well. That said, we are that earnings multiple is really tough to grow into, and we could see that come under pressure here, particularly that those core seven, which not for nothing, they are driving up the Nasdaq as well. So I think that has an implication on both of those P's.
What are the main risks that the tech sector face in terms of a valuation correction? In other words, what would need to happen for valuations to compress and stock prices to come down for these Mag 7 stocks?
But I mean, the multiples that we're talking about right now are really, really high. And so I think that, you could have just the momentum alone coming out of the market. If you start to see people rotating out of the large cap names and into some smaller cap stocks, could be enough to really be a pullback on some of these names. Interest rates are going to play a huge role, into technology names in general. They are highly sensitive to rates, and I do think that that is probably one of the major catalysts for future growth. Is if we are in an environment where we continue to see rates come down. On the other side, there could be some additional pressures on we are in an election year. We're really close to that happening. That is something that is going to become pretty prevalent on top of people's minds, and some of the policy changes that could happen, particularly around the hardware side.
What's different this time versus the tech bubble of 2000?
In terms of on the venture side or the private markets, or in the public?
Let's start with public markets first.
Sure,
the concern is that NVIDIA is the next Cisco. And do you see that happening?
Look, I don't. I think that you have NVIDIA's business is selling chips. That is banking on the proliferation of AI. In 2000, these were business models that didn't exist. We were in the earliest generations of technology in terms of the internet. And a lot of the companies that were going public and that were fetching astronomical valuations had essentially zero revenue. And so I think that that's the difference between then and now. I think that these businesses have been around. They have demonstrated their ability to kind of to transform industries. And I think that now we're just seeing a very rich valuation being ascribed to them versus a company that, companies like that were going public. More similarly from 2000, I'd say was the SPAC craze from 2021 than today.
Over the last couple of years, have we seen more tech innovation from the large big seven tech companies or from the private market side, the VC side?
It's a really good question. I think that we've seen innovation in different ways. I think that look, we've seen some tremendous outcomes on from the private market side that did go public here in the while there was an IPO window open, let's say pre 2021 or early 2021, that were really transformative. I'm just thinking about companies like Coinbase and really kind of emerging businesses that all the way back down to Uber. That really transformed the industry. So I do think that that should not be lost on anybody, that these business models that were highly transformative have kind of gone public and they're there now, whether they're a $150 billion market cap company or one of the Magnificent Seven. I think that they both accomplished a lot, but I think that the rate of transformation that Google and some of the larger names have had, and the other businesses that are of interest to them, just sticking with Uber, what Uber Eats has done to that business is phenomenal. And I think that their ability to continue to reinvent themselves, and it's not just Uber, but the ability to continue to forge ahead with new products and business lines has been really, really remarkable.
The large tech companies have done very well this year, most of them at least. Even Google, or Alphabet, one of the laggards in the space, is still up 19% year to date. The point I'm trying to make is whether or not these companies will have good long-term potential. I've heard from people working in the tech industry that some of these larger tech companies are seeing a bit of a culture shift from the earlier days. They're larger now. There's more bureaucracy. Innovation is slowing down. It's taking longer to come up with new ideas and products and release them to the public. They're not as nimble as they used to be. They can't, in some areas, they can't compete with, like I discussed with you earlier, the pace of innovation of some of these smaller companies emerging from the private sector side. So I'm wondering, as an investor, whether or not there's still longer term potential in terms of growth at these large tech companies. Are they still growth stocks, or are they now just Coca-Colas and value stocks?
So it's a really good question. Look, I think that this is a challenge that every business is going to face. I think your point, the sentiment that you've heard around, Alphabet and the culture, that is something that is kind of more prevalent now, I'd say, in the ecosystem. That look at you're just not an engineer or a project manager or someone that worked on product there. 15 years ago is going to be a completely different caliber employee than there today. I think that's a generalization that probably shouldn't be made, but it is out there. But yeah, look, what happens with these big companies is, they become much more bureaucratic. They start to go against kind of the ethos of how they got there. And so I do think that is a problem. It's a constant pressure that they do have. And look, at the end of the day, some of these companies will continue to surprise you. But I do think your point is well taken, and one that is, being digested by the markets right now.
Okay, final question on semiconductors. NVIDIA, who are their main competitors right now?
So honestly, I think that with NVIDIA, their biggest competitors are going to be some of these startups that are coming out of the market today. I think that the number of, and maybe the biggest competitor from my position is hopefully a company that doesn't even exist yet, because I think that there are so many really smart engineers that are working on products to compete with NVIDIA down the road. That there will be a tremendous number of players in the space. But from a direct perspective, we'll see. I do think that in the short and intermediate term, there are some other technologies that are out there that hopefully will take less of an energy burden and take some reluctance or take some reliance from NVIDIA away.
Is there a huge moat to enter the semi space? I mean, presumably you need a lot of capex for the infrastructure alone. Yeah,
a lot of capital. And look, we've seen this playbook work. Like, look at OpenAI right now. That last round of financing that they just pulled in, one of the largest in history, that creates a tremendous moat around that business. And so, we've seen this play out with NVIDIA as well. It's really hard to catch somebody with a financial moat around that company.
So how is a small startup going to challenge that?
That's from a technology perspective.
Okay.
My point is that the in demand chips today will most likely not be there in the next 5 years. But as of right now, I think that NVIDIA is really running away with this market.
You don't see AMD or Intel or Taiwan Semi catching up in any way in that market?
I think that they're nipping at the heels here, but NVIDIA is definitely the one that the market definitely loves.
Okay, so no real risk for now. Thank you very much, Jordan. I appreciate this talk. Where can we learn more from you and Tusk Ventures?
Tusk.vc, or you can follow us on X or LinkedIn.
Okay, thanks very much. We'll touch base again soon, and thank you for watching. Don't forget to like and subscribe.